We're here to talk about the Silicon Valley real estate market for the week ending February 27th, presented Saturday morning, February 28th. You may be wondering why my slides are labeled March 1st. I'll explain this March 1st later on in the presentation. Let's get into the data. These are the key chapters that we're going to be going over and the chapter numbers they correspond to, and there's timestamps down in the YouTube description below that you can jump to the sections you find most valuable to yourself. Here is the first summary slide. It's showing three major components. The first one is the turnover rate. How quickly is the market turning over? It's right now turning over 20% longer, takes 20% longer than it normally does to turn the market over one time. How do I determine normal? The normal is the previous 10 years, so 2016 through 2025, the median of those 10 years for the same week. So it's the week that ended on February 28th, and clearly this year I don't have February 28th data yet. So I'm actually using data that ended on February 27th. We're now at 20% longer marketing time than normal. The next thing that's of interest is the offers. It's about 93%. So we're missing about 7% of the number of transactions we normally have based on the previous 10 years. But that 7% we're missing is a smaller miss than the whole previous 3 years. So ever since the market correction of 2022 and the significant slide down here, we've had less than 90% of the market share of market activity. So the fact that we're now at 93% is pretty good. Moving on to inventory that I rushed before, you can see it's popping up here at about 114%, so 14% more than normal. Again, I give about 12% on each range of normal, of 100% to be normal. So inventory is normal, offers is normal, but the turnover rate is slightly slower than it normally is for this time of the year. But keep in mind, Silicon Valley is normally a very fast-paced marketplace, so the fact that it's a little slower really shouldn't bother anybody. Here is more metrics. Here's a little different presentation. This is this current week right down here in the center. I have trend data going into the future for the next quarter, so you can see which way the market is likely to go based on past performance. Now, there's no guarantee that this year will act like a normal year. And that's what the gray line is. That's your 10-year median. Your red line is the 10 percentile or the 90 percentile that favors the seller, red hot seller's marketplace. And the blue line is the 90 or the 10% that favors the buyer or nice cold buyer's marketplace. The first thing we're looking at is turnover time. You can see that we're at that 20% longer than normal. But how long is it? It's 36 days. That's 5 weeks. That's a reasonable time to turn over your entire inventory one time. That would like be a grocery store selling out all their inventory in 35 days if they didn't get restocked. Now, obviously, in both the real estate marketplace and the grocery store, there is restocking. So this is a theoretical number that will never happen. You can see it typical is 30 days. So you're almost 1 week slower than normal. A very similar number that some people get confused on is marketing time. How do I define the marketing time? It's the time it takes 3 out of 4 sellers to actually sell. That is actually right on top of the red hot marketplace. It's only 57% of the marketing time that it normally is. 50% of the sellers are selling in 15 days. The shortest is 14. The typical is 27. Right now, the individual sellers that are successful in selling are selling in very quick times. So the in-demand properties are actually selling quickly. The theoretical number takes into consideration the properties that never sell, the undesirable properties that take a long time. That's sort of part of why buyers that are out there are feeling the marketplace may actually feel the market slightly hotter than normal because the good properties are selling quicker than normal. They're selling in 15 days. And for any seller to expect to sell their property in 2 weeks is pretty incredible. Moving on to ask price reductions. This is the magnitude, the average magnitude of the seller's price reductions. Now you'll see that the number is very small, 0.3%. And that is actually 90%, 88% of where it normally is. So it's a little bit less than normal. Normal is 0.4%. So you can see that you're a little bit less price reductions. And the reason these numbers are so small is the vast majority of sellers do their homework before they put their house on the marketplace and do no price adjustments at all. And on top of that, if 3/4 of your sellers are selling in 2 weeks, that's not enough time for most sellers to adjust their price. Moving on to overbids. This is flipping over and seeing what the buyers are sensing. They're right on top of the gray line for all intents and purposes. They're currently overbidding an average of 6.3%. Typical at this time of the year was 5.8%. So they are overbidding 0.5% more than they typically do. When the market's slow, we're still overbidding 2.2%. So keep that in mind. Even in a slow marketplace in Silicon Valley, the average overbid is 2% above the seller's ask price. This is not an area where reasonable buyers come in, look at a reasonably priced house, and then try to negotiate the price down. If you have a way overpriced turkey, then you negotiate the price down. Or if the property's been sitting on the market, then you negotiate the price down. But if you have a property that you want, if you're just testing the marketplace, you can do anything you want. But if it's a property you want, it's priced reasonable, you don't go in and try to negotiate down in Silicon Valley. Offers accepted. This is just the raw number. You can see we're at 93%, so we're a little bit below typical. We're at 1,840 transactions. Normal is 1,975. So you're missing 135, which is less than 10%, which is why this is 93. You can see that we're normally gaining, and we're pretty much following the gray pattern. Yes, you can see last year we were right on top of the blue line, but you come back to, I would say it was right here between 4 and 3 weeks ago, the real change happened. So for the last 3 weeks, so 4 weeks total now, if you include this week, we've been basically having close to the normal number of offers. Inventory, look at the inventory just this last week. It's actually pulled away. It would have been completely normal. This last week it came up. Now, my own personal business, it would seem that last week was a little bit of a low week and stuff, and this week is a high week. And so it's some fluctuations back and forth. You had the Super Bowl and things like that impact things. The spring breaks in a lot of school districts were last week. So even when you had a new listing coming on the market last week, you didn't have the full marketplace because a lot of people were on week vacations, whether it be skiing or somewhere else, and not actively looking in the marketplace. But inventory, you can see, is 13% more than normal, and is it's right on the borderline where I start saying it's a little bit more than normal, but right on normal still. Then transactions, these are the closings. You can see that you're getting pretty close to the normal number of closings. You're at 93%. It's just a coincidence right now that offers accepted and closings are similar numbered. If you go back a couple of weeks and look at the presentations, they clearly were significantly different. Also, just for the record, I never posted last week's video, but I did have the handout there. So when we get to page slide 60, I try my best to get the slide presentation up. It takes me several hours to edit the video that I just didn't have this last week. So here's a summary slide. On the left-hand side is the raw count numbers, and you can see that they're mostly red in color, which means you have a hot marketplace, a fast-paced marketplace. But this green section here is compared to normal. And when you look at the compared to normal, you can see you have a lot of green, which would indicate you have basically a normal marketplace. Yes, there is some red, but there's also some blue. But it's basically saying the market's behaving more or less as balanced, and you can look at each metric. So these are raw accounts. The sale price, the overbidding, is orange in color because it lags by the 5 weeks that we need to close escrow. And offers and active inventory is light green because it by itself doesn't do you anything, which is why it's not on the left-hand side, because every micro market has a different size, but percentage compared to the 10-year median is useful. And then you have appreciation long-term since 2015, as well as the price. The median is in the middle, which is what the color is assigned by. But then you have the lowest 10 percentile and the highest 90 percentile on the right for every micro market area. Let's get into each map now. There's some definitions for folks. Here's the heat map of turnover rate. So red color here favors the seller. Blue favors the buyer. There's basically no blue except for over in Livermore, Dublin, Castro Valley area in Alameda County. The greens and the blue greens and the yellow greens are all shades of normal. And the color screen right here is for all the slides. I only show it on the first slide. So you got the raw count for Silicon Valley, each of the 3 counties, and then the micro market areas under each of the counties. So if you were looking at Milpitas, you're right there at 29 days. So what that says is you sell out the inventory 29 days, where the Silicon Valley as a whole is 37 days. So Milpitas is a faster paced marketplace than Silicon Valley, faster than just Santa Clara County. And if you look at it, it's one of the fastest. Now, it's not the fastest because you have Fremont down here at 10 days, and that's just lickety split on fire. And that's why Fremont slid up in the bright red. And then you can see how Union City and Newark right next door are green. And again, this is a great example of why I think it's important to look at micro market areas. If you're looking, and obviously, this area of Fremont may not be the same as this area because you have the Mission High School that may be driving this. My point is that you have to focus on local. Real estate is extremely local, and talking about Bay Area, even Silicon Valley, and even countywide now data is pretty pointless. Here's the turnover rate compared to the 10-year median. So you can see that Fremont is green. But even though Fremont is turning over in 10 days, that's what it's normally turning over in. So it gives you an idea of how fast paced it is. But now if you look at the heart of Santa Clara County, it's mostly blue. So it's saying that Santa Clara County, the heart of Santa Clara County, is selling a little slower. And if you look at some of these times, that's 61%, 36%, 50% slower than normal. It's only when you get over to the west side that you have times that are faster, 65%, 35% faster than normal, 14% for Saratoga, and Cupertino is closer to a balanced marketplace at 17. So you got the red areas over here in Los Altos, Palo Alto, down here in Los Gatos and Saratoga. You have the green in Cupertino and Sunnyvale, but a good part of Santa Clara County is blue. So it's taking longer than normal. But if you go back to the previous slide, what's longer than normal? It's 28 days, it's 30 days. It's still fast paced. So that's why it's important to look at data and pay attention to what the data is saying. Now, this is marketing time. This is the time it takes 3 out of 4 sellers to sell. And some people might argue this is a better benchmark. This is what the consumer is experiencing out there as far as the seller that wants to try to sell and the buyer that wants to try to buy. How quickly are the properties really turning over? And it's not a theoretical, it's an actual number. Now, the disadvantage of this number, it only counts the people that are successful in selling. So if a seller comes on the marketplace, tries to sell for a while, it does impact your turnover rate because it was an active listing, but it doesn't impact your marketing time because it never sold. And I only take the marketing time when the offer is accepted. Here's compared to normal. So now when you look at this, you can see you have a variety. You have green, which is normal. You have the yellow green, which I think is faster than normal. The blue green is slower than normal. And then you have the reds that are faster than normal. And the bright reds down here in Saratoga Los Gatos are quite a bit faster. So it's 2/3 the speed of normal. So it's 1/3 faster than normal in Saratoga Los Gatos. And even South County is faster than normal. And you also, if you've been following the data for a while, you start realizing there's some areas that are faster than normal, like Cupertino and Sunnyvale, and areas that are slower than normal, like Saratoga Los Gatos. And that's just normal. Every area can act abnormally in any given year. Here's the sellers' reductions. And these numbers are the average, which is why they are so small. So, East San Jose right now, they're raising their price 0.4%. I suspect, and I didn't have time to go look for it, I suspect what happened there is we have a data point where the listing agent put in this list price incorrectly, and then it came back and adjusted it. So for example, someone took a $1 million listing and listed it at 10 million, and then came back and corrected it to 1 million. That would count as a price reduction unless I go through and screen it. Now I do go through and screen and I try to catch all of them, but I would suspect I missed one in that particular micro market area this particular week. Here now is the frequency. So how common is overbidding? And again, this is compared to typical. You can see you're pretty much normal because you have sort of the pastel colors, a lot of green, but you have a little bit less price reductions than normal in Central San Jose. So maybe that is price increase. You have a little bit less than normal in Cupertino, Sunnyvale, a lot less in the expensive areas in San Mateo County. This is the frequency of those price reductions. So when it's bright red like that, it's just raw count. So you can see it's going to be very favorable to sellers. And look at these numbers in Santa Clara County, 2-3%. Now in Milpitas, it's 4%. So there's a range within each county. See, it's lower in San Mateo County or countywide, 6.3 versus 7.8% of the sellers are doing a price reduction. But less than 1 in 10 sellers are doing a price reduction in any of the 3 counties and in the region overall. So that's clearly tells you have a hot marketplace. This is the frequency compared to normal. So even though the previous slide was red hot, with the exception of San Mateo, which is a shade of red, most of this would be balanced. So 2 of the 3 counties is basically doing price reductions as infrequently as they normally do. San Mateo County is doing less frequent price reductions because price reductions are favoring the buyer. Here's overbidding. So this is the pressure that the buyers are feeling and how it's related to their actual bidding process. So you can see the Central San Jose, it's less than the other areas. And again, this is the raw data. So buyers are overbidding. How much are they overbidding? Anywhere from 2.4% in that Central San Jose, East San Jose area to 9% in Cupertino. In San Mateo County, anywhere from just 0.7% up to 8.6%. And in Fremont, 1.9% up to 18% in Berkeley. So Berkeley and Alameda Island continue to be the hot spots for whatever reason, not only in Alameda County, but in all of Silicon Valley, it seems to be the higher marketplace going on. This is compared to typical. So overbidding is completely normal. You can see it's pastel. There's some blue, along the East foothills and along the 87 corridor, but there's a lot of green. There's a little bit of red balancing out the blue. So it's completely balanced marketplace. And if you can look at that, you can see you're 105, you're half of 1% more overbidding than normal. 0.4 in Santa Clara County, 1.6% in San Mateo County, and 1% even in Alameda County. The frequency of overbidding, how common is the overbidding? This is the raw numbers, and these are raw, but they're sort of arbitrary. This 50 to 95% would be a red hot seller's marketplace. From a third to half the sellers getting an overbid is green in color. So you can see how aggressive the scaling is. And then in order to be favoring the buyer, it has to be 15% to a third of the sellers getting overbid. So that's almost insane when you think about it, to have a third of the sellers getting more than their asking price, and for me to say that's a buyer's marketplace. It's about as buyer's marketplace as Silicon Valley would get based on the last 25 years. This is the active inventory. The raw count is not on this slide because each micro market area has different size, so we have different numbers. So just the comparing to typical, you can see that we have a little bit more inventory, except for in Saratoga, Los Gatos, and Los Altos and Palo Alto, where you have a little bit of a shortage of inventory. San Mateo County Coast has a shortage, as well as the expensive areas. In Alameda County, I don't have county micro market data yet. Here is the appreciation. So this is long-term since the last 9 months of 2015. I was looking for a full year of stable prices, wasn't able to find it. So 98% means you have almost doubled your money. You can see that across the board in Silicon Valley and Santa Clara County, you're right close to 100%. San Mateo County is lower at 71%. I think the big influence for San Mateo County was the pandemic, where you basically had a loss of premium. People used to pay a premium to live close to work. With remote working coming along, that became a whole lot less important for the buyers, and so they weren't willing to pay the premium. So it hasn't gone up as much as Santa Clara County since the pandemic. And later on, we have a slide that shows that to some degree. On price, the median is the middle number, which is what the color code is set by. On the left is the cheapest 10 percentile in the given area. On the right is the most expensive 90 percentile in a given area. So you can see a price range, a sandwich for each area. This is the percentage of normal compared to offers. I'm a little out of order. It should have been up there before offer active, but that's okay. You can see that offers is about normal. 95% in Santa Clara County, 103% in San Mateo County, and 85% in Alameda County. That is up from where we've been basically the last 3 years, with only missing about 20%. So the three areas were about 80% in broad brush numbers. And here's some definitions for the upcoming different chapters. Here now what we're doing is we're looking at Silicon Valley all in a blender compared to the normal. So the gray line is the normal marketplace based on the previous 10-year median. The red would be the least 10 percentile marketing time, the quickest marketing time, turnover time, and the blue would be the longest marketing time, because a long turnover time favors. Here now is on a percentage basis. So you can see that we're 20% slower than normal. So we're taking 20% longer than normal. You can see just last year we were up at 70% for a short period of time, but we spent a lot of last year right in this 10 to 20 percentile range. And frankly, since 2025, we've been slower than normal. 2023 and 2024 was basically darn close to normal, even though we were not selling a lot of the properties and prices were coming down. Each metric tells you something slightly different. This is the marketing time. This is 3 out of 4 sellers. Look how dramatically that has changed since the first of the year. First of the year, you were up here at 50 days. Now you're down here at 15 days. So you're essentially half the time for the typical seller to sell. More significantly, you went from slower than the slow marketplaces. You were above the blue line, crashing through the gray line, and then coming down right on top of our red line. How do I possibly explain that rapid a change? Remember, at the end of the year that you have very little inventory. You have a whole lot of inventory coming on at the beginning part of the year, all with 0 days. Those 0 days are what's selling and attracting the buyer's interest. So that's why the market came down. Now, it came down more than normal, which is a heating up of the buyers, which is the buyers coming out of the woodwork a little bit more than normal, which is why we went from 80% to 93% of the normal number of offers. Here's on a percentage basis. So even though on a raw count, that number went way down, If you look carefully, you had this level thing this last week at a time when it's still normally going down. Because it was level when it's normally going down, when you compare it to typical, you slow down from basically 5% just last week, slower than normal, to now the turnover rate that's 20% slower than normal. That's still in the noise. There's a lot of noise in real estate, and the sample sizes are smaller than I would like just because we don't sell that many homes anymore. Here's the price reductions. This is one metric I actually like. This is what the sellers that are taking the largest price reductions. What are they taking? You can see that at the beginning part of the year, they were taking 16% off. Now, when you're talking about a $2 million property, that's a third of $1 million reducing from their original ask price. Now that seller that's taking the very biggest price reductions is down to only taking 9% price reduction, but 9% still 180,000. And when I say the largest, it's the top 2.5%. So I'm taking the 97.5th percentile. So only 2.5% sellers are taking more than this number, and 97.5% of the sellers are taking less. Why do I like it? Because it's sensitive and it moves. When you go to the next slide, which is average, it really doesn't move very much. Look at these numbers. You went from 1.6 to 0.04. Yes, that's a large percentage change, but it's a smaller number. I stick with the average because it's more basic. I throw in the 2.5 percentile because I like it. You can see that on an average basis, the average is right about where you'd expect it to be on the gray line. Here's compared to normal. You can see just a couple of weeks ago in 2026, we were taking slightly more average price reductions on magnitude, and now we're just right at average last week, and now we're slightly above. That's, I think, 2% above. I don't have the scale on the y-axis. Here's the frequency. So how common are price reductions? They're basically right where you'd expect them to be, and that's at 8% of the sellers taking a price reduction. So about 1 in 12 sellers reduces their own ask price before the offer comes in. Here's on a percentage basis. You can see that turned around last week and it's up slightly, but it's still less frequent than normal at about 98. Actually, that's about 95%. So 5% fewer sellers taking price reductions. Here's the median overbid. It's the only slide, I think, in my entire presentation where I look at the median. So half the buyers are paying more than 3.5% over, and half are paying less than 3.5% over. I normally look at the average on this, but both numbers are worth looking at. Here's compared to normal. So you're very close to the normal. And this is not a percentage of normal. This is just raw count. So basically you're a 0.5% more on your median overbid. Here's the frequency of overbidding. You can see you're about 62% of the sellers are getting more than they're asking. Exactly what the normal number is. So 62% of the sellers are getting more than their asking price. Here it is on a percentage basis. You can see it went down. So part of it would normally be going up because it was flat or going down. We went from 100% last week to 94% of normal. Still well within the normal range, but it is a turn. And that's why I'm looking at the raw number as well as the percentage of normal, because the cycle in real estate is so steep. It helps to normalize that by looking at percentage of normal. Here's my pricing model. You can see prices are skyrocketing at this time of year, and this is a lagging indicator because you need to wait for escrows to close. But I continue to maintain that, yes, we had about 12% appreciation for 7.5 years here prior to and through the pandemic, but post the 2022 price correction that we had at the very peak of the marketplace, we've been basically flat. And for the most part, this is still the high water mark. Yes, you go up and down. The downs tend to be at the end of every year, even when you were climbing. And that's just because there's a shift in the market mix. It's more that than the prices are actually, property values are actually declining. Property values do decline slightly, but I believe it's more market mix. Here's offers accepted compared to normal. You can see the raw counts over on the right-hand side, and it's about 1825, 1835, maybe somewhere in that area. And that's very close to normal. You can see how rapidly the number of offers per accepted go up. A lot of people look at pending transactions. The problem with pending, in my opinion, is a property that's pending for 10 weeks impacts your data twice as long as a property that's only in there for 5 and 10 times longer than a cash offer that closes in a week. I like looking at offers accepted over the past 5 weeks. Here's the active inventory. We're climbing up at this time of the year. We're climbing a little bit faster because you're getting a little bit close to the blue line, but you can see that you're right about 1,900 listings available in Silicon Valley in all 3 counties. And this is single family data only. Here's some more definitions. Now on this series, we're going through roughly the same data points, but what we're doing is we're comparing the 3 counties. So you can see blue is Santa Clara County, orange is San Mateo County, and gray is Alameda County. You can see that the turnover rate is slowest in Alameda County, fastest in Santa Clara County. And that's going to become interesting later on. Typical time to sell, tied for Santa Clara and San Mateo County. The two are right on top of one another. Alameda County is longer, the longer time for the seller to get the offer. Price reductions. Alameda County is taking the largest price reductions. Santa Clara and San Mateo are taking the same at about 1/4%. So you can see very small price reductions. Frequency of price reductions. Alameda County is taking the most at about 9%. Santa Clara in the middle about 7%. San Mateo the least at about 6%. Here's where it becomes interesting. Alameda County would have the longest turnover time, longest marketing time, most price reductions, most frequent price reductions. Look at this. It's got the most overbidding. Why would you ever expect that? I believe what's happening, and I don't have the data to back it up, but and it makes sense. Sellers in Alameda County are actually lowering their price. They're going under where the market actually is. Buyers are seeing that and going in and overbidding, but they're not overbidding that first week. They're overbidding after the sellers are doing their price reduction. So anyway, Alameda County leads in the magnitude of buyer overbidding about 7.5%. San Mateo County next at 6.5%, and in last place is Santa Clara County at about 5% overbidding. This is the frequency of overbidding, all very close together, all about 62% of the sellers getting more than their asking price. Appreciation, Santa Clara shines in this one. And here I did not subtract off the original number. So you basically have something like 110% appreciation for Santa Clara County. And Alameda County in the gray is right here out beating San Mateo very slightly, but they're both very close to about 73% appreciation. Very good appreciation when you're realizing you're only talking about 10 years. And most people leverage out their purchase. So return on the down payment is huge in real estate. Here's the median sold price. You can see that San Mateo County has come down dramatically in the last week while Santa Clara went up. So the two are very close together. And Alameda County, of course, is more affordable. Same information on regular paper that was logged. So you can see that both San Mateo County and Santa Clara are about 2 million, and Alameda County is just shy of 1.3 million for their median sold price. Here's the payment. I'm using the national conforming, but you can get lower interest rates, and that's especially if you have relationship pricing through your stock portfolio. Offers accepted. You can see Santa Clara County has the most offers accepted, followed by Alameda County. San Mateo County is always going to be in last place, as you can see, because it's a smaller geographical and population area, and inventory the same ratio. But here you can start seeing that Alameda County has slightly more inventory and slightly less sales, so you can see their turnover time is slower, and that's what we saw in Santa Clara counties. Okay, this slide's up here just for the bottom couple lines, but it was becoming less important. You go back just a couple weeks ago at the end of the year, and you were the 9th lowest year out of the last 10 years. You were the 24th lowest as far as offers accepted out of the last 25. Now you're becoming more reasonable. You're 7 and 20th out of the last 10, 25 years. So it's no longer where we were in 2023 and 2024, and even 2025, where we were having essentially the second worst year week after week after week. Here's the actual raw numbers, whether it be Santa Clara, San Mateo, or Alameda County, or Silicon Valley. Obviously, you don't have all the micro market data up there. You could get that on the summary sheets that were earlier. This is some customization I do for buyers. Here is the quick summary sheet of how we go there. This is the blue URL. I did have last week's up there, and I also have a tiny URL, which is up this week. It's the green root URL plus the letter H, the year 2026, the month 02, and the date 28. So this is where you put in the Saturday's date, even though the date is for March, comparing March 1st week, because that's my first week of the real estate fiscal year, because that way I have one discontinuity with leap year and the extra day of every year. The calendar lumps through one day a year, except for leap year when it jumps forward 2 days. And we'll talk another week about what I'm open for moving this away from Saturday to Monday or Tuesday, if anyone's interested in, communicate out if that's of interest. And then the URL to join live is just the green root URL in the year 2026, or the blue URL for those that want to do it. The archive for the YouTube channel. I'm Richard Calhoun with Creekside Realty, real estate broker with Creekside Realty, running out of time. Here's some more definitions for the distributions. Here's the first distribution on marketing time. The key here is you have every week you go from 50 percentile, because the data down here comes too close together, so spread it out up to the 90th percentile. You step through, we're starting off, the purple line is the current week. You start off on the dotted line, which was exactly a year ago, March 1st, 2025. And look at which direction it's going. It's going basically flat, slightly up. So what was that telling me? I'm expecting the market now to start taking longer and longer marketing time. Then it starts climbing up around May, and it just climbs up as we go into what a lot of people perceive to be the hot summer months in real estate. There's sort of the peak on July 26th. So that's one of the slowest times last year. And then it turned around and started actually plateaued there. I thought it turned there, it finally turns around. So it plateaued and then it came down. Look at how far it comes down. October 18th is the bottom of the speed up, the fastest of the speed up. And then you slow down for the end of the year. So now you're marching up. That's the slow time, right? January 10th. That's the peak of the marketplace. And then you, the slowest, and then you rapidly improve. Notice the right-hand side drops down too as you're improving. And the purple's right there. That's this week. Same thing with largest price reductions. You can see that last year you were a little bit larger price reductions, or a little fewer price reductions, because fewer up here at 0 would be the hottest marketplace. Stepping through, you can see you're really not changing. Now you're starting to drift down, drifting down more, and those aren't drifts, those are jump downs. So again, as you get into the summer months, the market's slowing down. And right there is sort of the slowest before we turn around and heat up a little bit. See the jump up? Now you have faster. There's another significant jump up. So that's the peak of the market right around October 15th. So you have a little rally, and then you slow down for the end of the year. And that ties in with, depending on what you're doing with buying and selling, when the best time to do different things is. That's the bottom at the end of the year, the slowest, the largest price reductions. And then you can see how rapidly the price reductions disappears. And that's where we are last week, which is sort of the peak. You can see how this week, that's last week, that's this week. See how it's jumped down a little bit? So the price reductions are already starting to increase. Now we're on to the final distribution, which is overbidding. This is how much pressure the buyers feel when they're making offers. You can see that 25% of the sellers are receiving less than ask price, but they're receiving only about 3.5%, well, I'll call it 4%, 3.5% less than their asking price. On the flip side, you have 10% right at asking price, and you have 65%. So 2/3 of the offers essentially are over the seller's ask price, going all the way up here at 5% of the sellers receiving about 34% above their ask price. So the amount of overbidding magnitude is significantly higher than the amount of underbidding. Buyers are very reluctant in general to go in under the seller's ask price. They wait for the seller to reduce their price. And as I said earlier in this presentation, that explains why Alameda County has the longest marketing time and the most price reductions they get, has the most overbidding. Anyway, let's step through. Concept's the same. Dotted line is where we're starting off, and that's last year. You can see that was just about the peak. Where does the market go from here? So it stayed at the peak for a couple more weeks. We're really plateauing. So that means the purple line really shouldn't move too much more from where it is this week. That's sort of the peak on April the 5th. That's closings. So the transactions middle to the end of February are when the overbidding competition is the most. So basically where we were this current week. Then you can see starting April 19th, it already started drifting down. So by middle of March, it starts dripping down. And that's in large part because of more inventory. Now you can see the market's just drifting down and getting cooler and less overbidding. And right about there on August the 23rd, actually was the bottom of the market for last 52 weeks. And then after we move forward from August, you can see it actually improves slightly as we get into September. Again, remember to take off the 5 weeks for closings of escrows. And right there's the peak on the middle of November. So the peak of the marketplace as far as the rebound at the end of the year is about the middle of October. And then you cool off to the end of the year. And it is noteworthy that the end of the year was actually slightly higher than it was back in August. As you can see, August is the dotted line down here. You can already see the improvement coming into 2026, and there's the current week. Here now we're moving on to the 5 regions of Northern California, covering 13 counties. Here are the regions, the counties, and some definitions for you. Here, what you're looking at, Silicon Valley has the fastest turnover time at about 38 and a half. I'm sorry, that's going to be more like 36 days to sell their inventory one time. So then you have the city, San Francisco and Marin next at 40. Then you have Central Valley and North Bay at just under 60 days. And the longest is the Central Coast, Santa Cruz and Monterey at about 75 days to sell their inventory one time. This is a theoretical number that will never happen because it assumes no new listings and the sales rate stays the same. Here's the time to sell for the typical successful seller. So here, this is a similar metric, but it ignores the sellers that aren't successful in selling, which is why the numbers are better than the turnover time. You can see for Silicon Valley, you're down around 15 days. San Francisco and Marin is up around 27 days. Then you jump all the way up to the North Bay, Central Valley at just under, we'll call it 59 days. Then the Central Coast at 68 days. And the longest one is the North Bay at 71 days for the typical seller to sell. That's 3 out of 4 sellers selling that amount of time or less. So the real hot spots, the standouts are San Francisco, Marin, and Santa Clara County, San Mateo County, and Alameda County, and Silicon Valley in the purple. Here is price reductions. Silicon Valley is doing the least amount of price reductions, and you're approaching sort of the arbitrary line for a red hot marketplace. And it's about a 0.5% price reduction, maybe, and I'm going to adjust these for percentages, but have not done so yet. San Francisco and Marin is next at about 0.75%, and these are average reductions. Then you have Central Valley at about 1.5%, 1.4% price reductions. North Bay at about 1.7%, and the Central Coast has the most price reductions at 2%. And keep in mind, 2% may not sound like much of a price reduction, but again, this is the average, so there's an awful lot of zeros. It's not as many zeros in Santa Cruz, and Monterey, which is why there's a higher discount, but it's only about a third of the sellers are getting above their asking price, and probably only about maybe as much as 1 in 4, 1 in 5 sellers, probably 1 in 4, 1 in 3 sellers are doing price reductions. Here's the frequency of price reductions. I should have just advanced to the next slide. So Santa Cruz, since we were just talking about it, is coming in at about 27.5% of the sellers are doing a price reduction. So just a little less than 1 in 4 sellers. Silicon Valley is the hottest at only 8%. So you need 12 sellers to find one that's done a price reduction. San Francisco Marin is at about 12.5% price reductions, maybe even 13%. Then you have Central Coast and North Bay right there tied together at 27%, and the area that's doing the most price reductions is the Central Valley at 30%. So no area currently is even taking 1 out of 3. Obviously, Central Valley is close to 1 out of 3. North Bay and Central Santa Cruz is close to 1 out of 4. It's slightly over 1 out of 4. Overbidding. This is the pressure buyers feel. The most pressure is in the city, San Francisco and Marin, at about 11% overbidding. Actually, it's about 10.5% overbidding. Then you come down to Silicon Valley, about 6.25% overbidding. North Bay at just about 2.5% overbidding. And then Central Valley is actually a price reduction, about 0.5% price reduction. And the Santa Cruz, Monterey Peninsula, South Coast area is basically at 1.5% price reduction on average. And that's at the time the offer comes in. So overbid is what the buyers overbid on the accepted offers. Reductions are what the buyer takes off the seller's ask price. And it is actually interesting for me to see that the discount here that the buyers are doing in Santa Cruz is still 1.5% at the time the offer comes in. For a Silicon Valley area, I would consider that to be very steep. Frequency of overbidding, most areas of San Francisco and Marin at about 74% of the sellers getting overbid. Silicon Valley at 62%. North Bay at about 38%, Central Valley at 34%, less than 1 in 3, and the least amount of overbidding is in Santa Cruz at about 28%. So somewhere between 1 in 3 and 1 in 4 sellers are getting an overbid. Here's the long-term appreciation. The takeaway continues to be San Francisco and Marin is doing the least well out of the pack. Central Valley had been doing the best, but Silicon Valley shot up this last week and came up here and has now 90% appreciation. It's the highest. Central Coast is at just under 70% appreciation, and North Bay is at about 55% appreciation. That's since the last 9 months of 2015. Here we have the median sold price of the 5 regions that make up the Greater Bay Area. We have San Francisco and the cities, which is the highest price at somewhere around 1.725 maybe on the price. And you can see that the first reached the price point back in second quarter of 2021, also reaching it back then. Further in the second quarter of 2021 was the Central Coast. Also, very late first quarter, very early second quarter was the North Bay. Later in the cycle is the Central Valley, basically beginning at second quarter of 2022, Santa Cruz, Monterey, first quarter of 2022, Silicon Valley, very end of first quarter of 2022. So you can see there's two different areas, but they're all below their previous 2022 peaks. Everybody peaked in 2022. Silicon Valley reached the peak momentarily in 2024, but we're currently below it. It also reached it momentarily in 2025. We have that yearly cycle of the prices. And so, Silicon Valley is close. It's a little bit below. If you track the price now, it's actually probably exactly where it was in 2022 at the peak for the same time of the year. This is first quarter right here at the end of first quarter, and you're right about the dotted line. You come over here and you're basically just before the first quarter and you're on that same dotted line. But anyway, you can see the prices have been essentially flat with the annual cycles for the last 4 years. Here's the estimated payment using the high balance conforming money for the national average published by the Federal Reserve, which is now below 5%, below 6%. I think it was 5.98 or something like that. And I do have a client that's actually getting 5.5% through, believe it or not, Rocket Mortgage, because they have a significant retirement fund in stocks with Charles Schwab. And as most banks now have relationship pricing, Wells Fargo, Citibank, B of A, and Rocket Mortgage, and probably everybody else. So you find out who your stock portfolio is with, and then find out their partner mortgage company, bank lender, and then go with them, and they give you basically an 8% price reduction on your interest rate for every $250,000. Every lender is slightly different, but that's it in a nutshell. So your payments are in the same order as the price of the home, because it's just going through a mathematical formula, assuming a 30-year fix, an assumption for property tax at 1.25%, and an estimate for insurance. Here's offers accepted. You can see that the Silicon Valley is the most active area with the most offers accepted at just about 1,800 offers. Then you have Central Valley and North Bay that are very similar in size at about 1,600, and much smaller geographical and population-wise are the Central Coast and the cities, and they're down around 300 transactions. Clearly, you can see that the two counties down here are roughly the same size in Silicon Valley, and the other two counties are roughly the same. You do come back here and you can see that Central Valley has been the same as Silicon Valley historically at times, and below at other times. So it all depends on where the market activity is happening. There's active inventory. So you can see, even though Silicon Valley had the most offers accepted, it doesn't have the most offers, which most likely will translate to having the fastest activity level, because it's had the most offers with less than the most active listings, and therefore it's got a faster turnover time. Fastest turnover time is hard to tell. You have to do a ratio. So this is just active inventory. So Central Valley and North Bay has the most inventory, and you can see that they typically do. When the heat of the market, they all got down about roughly the same size, all three of them. And then Silicon Valley is by itself now middle inventory. And then you have Central Coast and Marin and San Francisco's having the least amount of inventory, but they're also probably the smallest. You can see the orange is almost always on the bottom of the blue. Here's the raw numbers, slightly different presentation. Again, the now column is the current week. The 1 week is the percent change from the 1 week ago, and 5 weeks is the percent change from 5 weeks ago. Appreciation is just the current value now. On the 10 and 90 percentile, just have the current values. And then on the median, I have the now value as well as the dollar change from a week ago and 5 weeks ago. Again, I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Appreciate likes and subscriptions to the YouTube video. This is going to be a little confusing. The handout, PowerPoint handout is up there. This is for as of March the 1st. How can I have it as of March the 1st when the presentation and the link up here is actually February 28th? I basically take instead of Sunday, March the 1st, I'm taking the Sunday from 5 weeks ago and using that instead. once we're past March 1st, so next weekend, this week's data is updated to include the March 1st data. I update the data because it's a live database for 13 weeks. It gets every year we advance by one, and in the leap year you advance by 2 days of the week. And so right now it's on Sunday. In another year, it's going to be on Monday. And then in 2 years from now, it's going to be on Wednesday. When it starts being on Wednesday, you have not as much. There's not much activity happens on the weekend. There's a lot of activity out there in the field, but there's not many reportings of sales, and there, in theory, should be no closings. Now, there are closings that get reported that probably happened on Friday, but the agent was late doing it, and some of the input systems don't let you put a date in the past, and so they have to put in today's date to be as accurate as they can, since they didn't report it on the day of the recording. If you want to join the Saturday morning presentation, you can type in the longer blue URL link here, or you can type in the shorter green root URL with the year 2026. The archive YouTube link is here, or just the shorter green root URL takes you right to the YouTube archive. And with that, I think I'm done for the week. I don't see any unmuted mics, so thanks for joining. Take care. Bye for now.